Salam sejahtera. Good afternoon and thank you for joining this event. Welcome to this session on international trade. I'm your speaker, Alan Tang from Standard Chartered Bank. In the next 45 minutes or so, we will cover 4 topics. One being what revolves around international trade. Number 2, payment risk in international trade. Number 3, trade and working capital cycle. And lastly, understanding of documentary trade. Now, international trade is the exchange of goods and services between countries. Trading globally gives consumer the opportunity to be exposed to goods and services which are not available in their own countries, or is it more expensive domestically? When an organization decides to engage in international trade, it takes on additional risks along with the opportunities. The risks associated in international trade are commercial risks, country risks, foreign exchange risks, and political risks. Now, before I start this presentation, I'd just like to make note to the audience that you can actually ask your questions, but please post it into the Q&A section, and we will take on all your questions at the end of the session. Sorry for the pause. Okay, now let's get started. Now, what revolves around international trade? Now, from the bank's perspective, together with the exporter, there are actually 3 things that revolves around international trade. First being trade regulations and restrictions. Second being documentations. Third being methods of payment. Now, coming to trade regulation and restrictions, we are actually talking about regulations and restrictions such as trade sanctions, right? Foreign exchange controls, and acts or basically laws passed by Parliament. For example, Strategic Trade Act. Now, in this case, trade sanction is something that the bank look at it very seriously, right? Together with the exporter as well, because any violation of trade sanctions can result in quite serious repercussions. That is, there could be anything coming from a trade restriction perspective. If any violation of this can actually affect in basically fines, hefty fines, and reputation risk as well. Okay. Now, what trade sanctions are we talking about? For example, it can be a country sanction. A country sanction, for example, Iran, North Korea, these are under basically the country sanctions under OFAC, right, and United Nations. And there can be sanctions on specific persons as well. Now, specific persons can be any individuals that is being blacklisted, right? So that are also trade sanctions. Now, where the bank gets involved in these particular sanctions is when documentation pass through the banks, it actually need to be reviewed. And at that point of time, then it will be actually rescanned through to see whether any of those transactions are involved in these trade sanctions. The other item is on foreign exchange control. Now, foreign exchange control, as you know, for Malaysia, ringgit is not tradable outside of Malaysia. So that is also a point to take note. As you can see, current international trade today is denominated in mainly US dollar transactions and other currencies. Okay. Now, the other one is on Strategic Trade Act. Now, for Strategic Trade Act is a law passed by the Malaysian Parliament, right, in 2010. And basically what that entails is a law to control the export of sensitive technology and materials in order to combat terrorism, nuclear proliferation, and the spread of weapons of mass destruction. So what this means for an exporter is that if the business of the exporter, the trade is involved in such items, then they need to make a certain declaration, right? If they don't have, also they have to make a declaration that they don't deal with these goods. But if they do, then they actually have to make a declarations, and probably certain approvals has to be obtained from the authorities. Okay. Now, second thing that revolves around international trade and is very important is documentations. Now, export of goods, what actually holds a title to the goods is the shipping documents. Now, as you can see, I've listed a few. There's also other documents such as financial. Financial here refers to any instrument that claims payment. It can be basically a check, it can be a promissory note, or it can be also a bill of exchange. That is financial documents. Commercial documents are related to anything that deal with description of the goods and probably a sale agreement between the buyer and the seller. So a simple one here would be an invoice, a commercial invoice, a packing list, and so forth. Now, as we mentioned just now, transport shipping documents, these are the key documents whereby if a transaction goes through the bank would normally request for these documents. And of course, the buyer will also request for such documents. Now, the main key thing that the bank looks at from here is actually the shipment from destination, from loading to destination. This is basically to ensure that there is actually evidence of shipment moving from place A to place B. So that shipping documents, like for example, shipment by sea, the shipping document is bill of lading. That document also proves as a proof of shipment, right? A document of title, right? So it means the bearer of that document, name in the bill of lading, actually has a right to go and claim the goods. Okay, so these are the key documentations in international trade. Apart from that, Incoterms is also key and important because this defines the cost and also the responsibility between the buyer and the seller, right? Between the importer and the exporter. So at what stages of the shipment, right, the responsibility is stretched until is covered by the exporter, and at which point onwards is actually covered by the importer, is spelled out in the Incoterms. And this Incoterms is normally, you can see in all the commercial documents, right? So with these documentations and also the Incoterms, it's actually very clear now to the buyer and between the buyer and the seller, right? What have they agreed upon, and how would they want to ship their goods, and who would bear the cost along the way. Okay. Now, the third key thing that revolves around international trade is the methods of payment. Now, in international trade today, and since years ago, these four payments has been there for a while, and it has been proven. Actually, around 70% of document trade today is under letters of credit. So, and about more than 30% today, right, is under documentary trade, right? So what are the methods of payment we are talking about is advance payment. Now, advance payment being very simple, it is basically payment of cash in advance first, only then you ship the goods, okay? Now, on the other extreme, there is open account. Now, what is open account? This is not your typical open account. This basically means the exact opposite of advance payment. It means the goods is actually shipped before payments are received. Okay. Now, obviously, for the seller, advance payment or the exporter is something that they actually look forward to, right? When you receive the cash, only then you make the shipment. An open account would be something that the importer will be looking forward to, but not the exporter, right? Because you need to ship first before you actually make payment at the end, right, later. So in international trade, normally they will actually have to come to a common ground, right? Because at both extremes, the common ground will be documentary collection or letters of credit. Now, in documentary collection, what that means is basically there has to be a middle ground party. Normally, it's the bank, right? The bank will hold payment on one hand, and they will also pay the also hold the title of documents on the other hand, right? Once they have both, they will exchange. Once they exchange, the buyer is happy that they actually get their goods. The seller is happy that they get their payment, right? This process is what we call documentary collection. And what controls all this will be all the documents in number 2 that we mentioned, right? That controls the flow of this transaction. We'll talk about this a bit later in the later slide and give you a better understanding. Okay. Now, lastly is letters of credit. Now, letters of credit, as you may have heard, is actually quite common in international trade, right? A lot of people talk about letters of credit. It can be also called documentary credit. Both are the same thing. So what is this actually is, you look at it as something like a middle ground, same as middle ground as documentary collection. That on one hand, the bank has the payment, holding on to the payment. The other hand, the bank holds on to the document. But on top of that, from an exporter perspective, if you do an international trade, right, you may be thinking, if I ship my goods, okay, then I will get my payment later from documentary collection. But what if my goods have arrived at the port, but then the importer decides not to clear the goods? He doesn't want the goods. Then for an exporter, I will actually be in a position where I have to ship back my goods. And at that point of time, you will probably have incurred a lot of demurrage costs, transportation costs, and so forth, right? Because your main objective as an exporter is to basically sell off your goods, right? So there's an option where the exporter can actually get a guarantee of payment, meaning to say that the moment that you put your goods on the ship and it sails, right? And if as long as you can comply to the certain set of conditions, right, stipulated, then you'll be paid. Be paid by who? Be paid by the importer's bank or the buyer's bank. Okay, so it's a form of guarantee of payment on condition that you fulfill certain conditions. Okay, so now these are the 3 things that revolves around international trade. We will talk about certain things in a little bit more detail further on. Now, to understand international trade, we must first address the payment risk in international trade. Now, earlier we spoke about the payment methods, right? Open account, documentary collection, letters of credit, and advance payment. Now, in this particular slide, you can see that we have put the exporter on the left, the importer on the right. And what actually differentiates this is the risk, the risk. To the exporter, open account has the highest risk. Why? It's because they ship their goods, only then they get paid at the end, right? The risk is non-payment. Now, on the other extreme, at the bottom, is advance payment. Of course, this favors the exporters the best because they will actually be paid before they actually make their shipment. So for them, from a payment risk perspective, is actually the lowest and the best. But of course, we said that all this cannot be normally agreed between buyer and seller, right? So the common ground here will be documentary collection and letters of credit. Now, you can see on the right-hand side, the importer is the other way round, right? Advance payment is the highest risk and open account is being the lowest risk. Now, coming back to the exporter, on documentary collection, why will we deem as highest risk as letter of credit? Now, the simple answer to this is that in the letter of credit, as we mentioned just now, it has the guarantee of payment coming from the importer's bank. Okay, so that is an added comfort. So when they make the shipment, the guarantee is there. Hence, the risk is actually lower compared to documentary collection, which doesn't carry any guarantees. Now, if you compare against the importer, right, letters of credit is deemed higher risk compared to documentary collection. Now, why? Now, letters of credit, as we know, as long as the exporter is able to fulfill the set of conditions stipulated in the letter of credit, then the guarantee to pay is there already. Okay, so coming back to that simple example as to the exporter make the shipment. So when it reaches the port, right, under documentary collection, if he decides not to accept to pay, it may happen. So that is the amount of risk in documentary collection, whereby an exporter needs to bear, right? Compared to the letter of credit, if the shipment arrives at the port, and if let's say the importer decides that no, I don't want the shipment, I don't want to take the shipment, under letters of credit, as long as the exporter is able to provide the documents that fulfill the LC condition, the letter of credit conditions, then the importer's bank will fulfill the guarantee by making payment. Okay, so once they make payment, of course, due date, they will come to look for importer for the payment, right? So in that particular sense, right, purely from the payment risk sense, letter of credit will be deemed slightly on a higher risk because someone is undertaking to pay and you will have to pay back that particular entity. Okay. Now we are coming to trade and working capital. Now, as we know, a typical working capital cycle of an exporter and how bank products can service the working capital cycle. So over here, you can see that a typical working capital cycle for an exporter, they will first need to procure and source for the imports, right? And subsequently, they will get a purchase order and they will actually prepare for the exports process, right? So over here, you can see on the import side, if you just quickly go through the various stages, purchase order is issued, contract is established, right? At that point of time, they have an option. If let's say they have a existing bank facility with the bank, they can actually approach the bank, and if the negotiating terms, if the sales contract specify that a letter of credit is required, then they can actually come to the bank to apply for one, and the bank will help to issue a letter of credit. Okay. Now, goods is shipped, right? Subsequently, documents received, right? The goods will probably be in the port currently, right? At this point of time, the service that the banks can render is called the import bills collection. Now, in this particular stage, it can be either documentary collection, which doesn't have an LC, or it can be import bills collection, whereby there is an LC involved. Both the documents needs to be passed through the bank, right? The bank will hold the documents until the buyer importer satisfied they are able to make the payment. Then the documents are released to the importer in order for them to clear the goods from the port. Okay. Now moving forward, the next stage when it comes to the payment. Now under payment, the various products or services that can be rendered includes import finance I, accepted bills I, and import invoice financing I. These are various products whereby can also finance. Each has its own features that will benefit in different scenarios. Now, after procurement, right, for an exporter or a trader, they will then source for their customers and where to sell it to. So once the deal is secured, they will receive a purchase order, right? Or from the other aspect, they will receive letters of credit if the sales contract calls for one. Okay. Now they will then prepare the goods. Either they have to repack it or they have to add value and the finished goods is ready. Then they will actually ship the goods. Okay. When they ship the goods, at that point of time, the commercial documents will then be generated. Sales invoice will be raised. Now, at this particular point of time, if it's, let's say, under non-letters of credit, there's this thing called the export bills collection. If it's letters of credit, there is an option for the client, right? Apart from before they're presenting the documents, they can actually request for their banks, right, for their banker to add confirmation. Now, what is adding confirmation? Now, we will discuss this in a bit more detail later, but just quickly, adding confirmation is something similar to like buying an insurance, right? Buying an insurance on who? Buying an insurance on the letter of credit that you receive. Okay, so we will explain a bit more detail later on, but let's move forward from here. Now, the next stage is when the documents are presented over to the issuing bank. Issuing bank will then accept the documents together with the importer. So at this point of time, when they have accepted, it means that basically it will be time for payment. But if let's say the transaction is agreed under term credit, meaning to say there's 30 days, 60 days, or 90 days of payment, then the exporter will then have to wait until the maturity of the 90 days or so, only then they'll get the payment. So this stage, what we are saying is that an exporter has an option to come to the bank and obtain financing. Now, this kind of financing can be done in two ways. One is either they have a facility with the bank, right? They can draw down, or they don't have a facility, but as long as the LCs and conditions all fulfill, right? So at that point of time, even if the LC is also accepted by the issuing bank, there's an option whereby if they don't have facility, they can apply for a facility called LC discounting, and it can be also financed. Okay. And lastly is that payments received on due date, and that will be used to settle the earlier export financing that they have obtained. Or if there's no financing, then the proceeds will then be further credited to the exporter. Now, the next stage, for the next few slides, we will be discussing on understanding documentary trade. This is quite a simple flow, right? We will have one flow on documentary collections. We will have one flow on letters of credit. And we have the final flow on the return leg, which is the payment settlement of the letters of credit. Okay, so along the way, if I hope I'm not going too fast, but if you have any questions that you'd like to ask, you can actually post it into the Q&A session. So at the end of this session, I'll then address all your questions. So coming to documentary collection flow, there's basically four parties: the importer, the exporter, the collecting bank, which represents the importer, and the remitting bank, which is the exporter's bank. There will be a commercial contract first to be established between importer and exporter. And within the contract, we will then spell out exactly what is the pricing, what is the amount to be shipped, when is it to be shipped, right, on what mode of transportation, everything you mentioned in the commercial contract. Then the exporter will then start to ship the goods. The goods will then arrive at the importer's port of discharge. Exporter at the same time will present documents, shipping documents, all set of documents, including financial, commercial, and also transport documents to the remitting bank, right? And the remitting bank will then forward the set of shipping documents to the collecting bank. Okay. Now at this stage in the remitting bank, normally the banks do not do a major checking. They will probably just ensure that the numbers of documents that is specified in the exporter's application form will be there. So for example, say 3 BL will be there, 3 copies of BL, 3 copies of invoice. All that stated will be counted, and remitting bank will ensure that it's there. Okay, from here, remitting bank will then forward the documents to collecting bank together with this document, together with the bank's instruction. Okay, called the bank covering schedule. So in the instruction, it will instruct the collecting bank to release the documents to the importer, right, in exchange of payment. Okay, or if let's say if there's a term, if there's a credit term involved, then it will request the importer to sign an acceptance, right, before releasing the set of documents to the importer. Now, why is it important that the importer must obtain this set of documents? Is because within this set of documents, there is a document of title called Bill of Lading, and that gives the right for the importer to go to the port of discharge to claim for the goods. Okay, so in summary, if we look at export collection side, right, from the exporter point of view, right? So these are the few key steps that the exporter needs to do in the documentary collection, right? And at the same time, I will also share with you what are the bank services that can help assist along the way. One of it is prepare collection documents. Now, currently, the documentations, for example, invoice, all the financials and commercial documents is actually prepared by the exporter themselves. Okay, other documents they will need to liaise with third party, but that also requires some form of preparation of drafts and all that, right? So in the industry today, there are certain banks that has this service called document preparation service. Now, this service is rendered to clients who wants to outsource this to the banks, right? So also, this service has been around for some time, about 20, 30 years in the banking industry. But what is moving forward with the digital age is that this type of service is now further outsourced to the specialized companies. Now, specialized companies, they actually just perform one specialized task, which is only preparing documents. So these kind of companies are now slowly taking over from the banks to process, but at the same time, they partner with the bank to ensure that the customer's documents from the preparation stage all the way until collecting the payment, right, is properly handled at that point. So this is stage one. Now, stage two is an exporter will have a requirement to present the documents after they are prepared, right? So present documents means that the exporter set of documents have to reach the exporting bank's counter. Okay. Now that is called presenting of documents. On top of that, what the bank does when they receive the documents is they will need to actually go through and check the documents, right? Check the documents for any discrepancies, not to say discrepancies, but any misrepresentation in the sense that certain documents, like 3 copies mentioned here, but actual copies received is actually only 2 copies or so. So this is basically ensuring, right, that what the exporter present is what it is you have in the whole set of documents. Okay. Now, apart from this, the banks to confirm that this whole set is in order, they issue a covering schedule, which we mentioned just now, is an instruction to the importing bank. Okay. Now, of course, on step 3, after sending the documents, the exporter will need to keep on following up, tracking for payment, when will it be paid, is the document received in order. So they have this requirement, and what the banks offer is that they will actually send the traces and status monitoring, right, to the exporter to inform them on various stages the documents is at right now. Okay, and finally, step 4, payment, right? On payment, if it's going to be a side document, meaning to say there's no credit terms, then payment can be obtained after the exporting bank receive payment from the importing bank, right? If there's going to be a credit payment, then the option of financing is always available, right, with the bank. And step 5 and the final one will be accounts receivables matching reconciliation. Of course, all this is for the accounting and bookkeeping purposes. Nowadays, banks are evolving towards e-banking. So under the e-banking module, there are statements, alerts, and advisors which you can track, and there's a historical record. So that is actually good for the exporters' audit requirements and all that. Okay. Now, coming into letters of credit I, this will be purely on letters of credit. So this slide is on issuance and advising, right? Because compared against documentary collection, whereby sending the documents for claim for payment, right, is one flow, but letters of credit involves a guarantee of payment and undertaking coming from the importer's bank. So there's actually 2 flows to this, right? The first flow is involving issuing and advising. Okay, it will actually starts from there's a contract that's agreed between exporter and importer. Okay. Now the importer, it starts from the importer. They would then need to go to the issuing their banker, right, to request to apply for a letter of credit. Okay. So if the payment terms is agreed by a seller, letter of credit, the importer needs to ensure that they have a banking facility, a trade facility that allows them to issue a letter of credit. Okay, so if that is in place already, they will apply for a letter of credit when the transaction requirement comes, and the bank will then help them to issue a letter of credit to the advising bank. Now, a letter of credit, as you mentioned just now, is a document whereby it actually contains a set of terms and conditions for the exporter to fulfill. So in short, basically, it will actually demand for certain documentations that it wants, right? So certain set of documentation, the number of set of documentation, the documentation must mention certain things that they want, right? So all that is documented in this thing called the letter of credit. So once the letter of credit is being issued, it actually issued to not directly to the exporter, but it issues to the exporter's bank. Okay, so this will be specified upfront who the exporter bank is. Okay, so the exporter bank here will be called the advising bank, because at this stage, what they do is they receive this SWIFT message. Now, letter of credit is issued in SWIFT MT700 series message. They receive this SWIFT message, and they will need to do a certain, like we mentioned just now, the regulatory restrictions and all that, sanction checks and all that. Once he has cleared that, they will then inform the exporter to either you come and collect the letters of credit, or in today, if there's e-banking and so forth, it can be advised electronically to the exporter. Yeah. So this completes the first cycle of LC issuance and how is it being advised to the exporter. Now on the subsequent flow, you can see that this is the stage where the exporter, after receiving this set of conditions, they will start procurement, they will start preparing their goods and to ensure that it's ready to ship. Okay, so once it's all done, they will ship the goods under number 1, right? At this point of time, they will then get a set of shipping documents together with their invoice and their bill of exchange, everything included. They will then present it to their own banker. Okay, this bank can be the same bank as the advising bank just now, right, in the previous slide, or it can be a different bank, right? But most important is this bank basically is the exporter is a client of this bank. That means they either have an account open or they have transact before with this particular bank, and they have a record of this exporter. So they present documents to this bank. This bank is in the LC term is called nominated bank, right? So what these nominated banks' responsibilities are is to check through the documents, to do the first check, to ensure that the documents comply to what the LC is calling for. Okay, so let's say everything is checked and is good, right? Nominated bank will then present this document to the issuing bank. Okay, you can see in step number 3, they present it to the issuing bank. Now, issuing bank is the key party to basically ensure that whether this letter of credit can be paid or cannot be paid, right? So they will check again, right? Under their own standards, they will check again, right? And after checking if the documents comply means that the documents there's no errors or discrepancies. Issuing bank will then make the payment to the nominated bank, okay? And the nominated bank can credit the payment to the exporter. Now, at this stage, the issuing bank under UCP 600, right, basically states that if the issuing bank has checked and the documents are clean and it's a site LC, they have 5 days to respond, okay, to make payment, right? Then at the same time, the issuing bank will then request the importer that your documents have arrived, and if you want to claim your documents, please sign either to accept to pay us or to pay us on a site basis, and we can actually release the documents to you to claim from the port. Okay, so this second slide actually completes the LC issuance cycle, right? Now, from the exporter point of view, an export letter of credit life cycle happens in 7 stages, right? There will be the stage where the exporter, when they prepare the documents, but even before they prepare the documents, they need the LC to be verified. Verified is just a term. What happens is that if they get a draft LC from the importer, right, they want to minimize any LC amendments or any changes to the LC, right? They can actually get the banks to actually look through the LC while it's actually the LC is not in adverse or in not in favor of the exporter. Okay, something the exporter can actually fulfill and present their documents. Okay, that stage is called LC verification, and the bank that provide these services, this is called an LC vetting, right? LC vetting procedure. Number 2 is receiving the actual LC itself. So when they receive the actual itself, they're going to receive it through their banker, right? The banker receive it and they're going to advise it to them, right? Step 3 is obtaining risk cover. Now, what this means is coming back to just now you mentioned about this thing called LC confirmation, right? LC confirmation, like we mentioned just now, is something like buying an insurance over the LC. Insurance against what kind of risk? Now, here we explain a bit more. Insurance against the issuing bank, okay? The issuing bank risk, right? So why do you need insurance against issuing bank? It's because the issuing bank, there are also issuing bank that are very good in rating. There are also issuing bank globally that are not so good in rating, right? So if you are an exporter, right, if you receive an LC from a not so good rating issuing bank, if you want to improve the rating, right, you can actually approach your banker and ask the banker whether can you add a confirmation over this LC. So what confirmation does is that the bank that you approach that is willing to add the confirmation is going to give you a second guarantee. Okay, guarantee on who? Now, if you look at the original LC, it's a guarantee of payment in the event the buyer doesn't pay, right? The applicant or the buyer of the LC doesn't pay, right? This confirmation is a guarantee of payment in the event the issuing bank doesn't pay. Okay, so this is an LC confirmation. So that is step 3. Step 4 is preparing documents. Of course, when the LC is received, they'll start to prepare, right? So preparing documents, as you mentioned, now certain banks provide or certain banks partner with these preparation services out there, outsourced company. These services is also provided. Then, of course, when you prepare the documents, it has to be checked, right? The checking is an important step because it needs to ensure that the LC is 100% accurate. Okay. Now the thing with letters of credit is that it's good to have a letters of credit as an exporter because you get a guarantee of payment. Even better if you confirm the LC because you get a second guarantee of payment on the issuing bank risk, right? But all this good stuff is on condition that the documents you present to the bank is all accurate according to the LC, right? So you must have certain skills to prepare the documents and make sure that it's checked and it's 100% accurate. Because in an LC, even if 99% correct, 1% not correct, it is called discrepant. So in that situation, the issuing bank may opt not to pay until the buyer comes and accept the discrepancy and they pay. Then everything will continue as normal. Until then, if you have discrepant documents, no matter if it's 99% correct or it's 50% correct, it's still not correct. Okay, it's still under discrepant status. That's why this examination and pre-examination stages are very important. Okay. Now, payment tracking, of course, any document sent already, you need to track on the payments and the follow-ups. This will also be provided currently. And of course, lastly, if it's a credit term, you require financing, there's various options today to seek for financing, right? Even in letters of credit also, there's various forms of seeking financing. Now, for the next few slides, we are going to touch on some of the bank services in the industry today, which some of it can be, how would you say, can be optional, right? But each services that is provided in the next few slides is basically to help to improve the exporter's point of view in their documentations, okay? Number one here is LC confirmation. I think just now we have mentioned confirmation. What risk does it cover is important. It covers two risks. One is the bank risk, okay, of the issuing bank, right? Right. That's why it improves the credit rating if you were to confirm. Two is country or political risk, okay? Country or political risk meaning to say that I think there was a certain time that an export was to a certain country, and I think that country suddenly there was a regulation, central bank regulation around you can't pay in the local currency of the particular country that you exported to. Now, because of that, everyone started to panic. Oh no, what are we going to do about that? Because you can't pay in that particular currency, you have to actually convert. So the moment you convert, there's actually exchange risk and so on and so forth. So this is one example. So other examples are other kind of restrictions that is being suddenly imposed, then it will actually cover, right, on confirmation. So moving forward, the other types of services that a bank can render is also this service called direct export presentation. This is actually a term used, as you know, from a Standard Chartered bank, but in other banks they call it different names. But in essence, how this help the exporter, right, is that if you look at the flow, the exporter, once the LC is being advised to them, okay, they will then prepare the documents. Right? At the point where the documents that they need to present to their own banker, currently, I think more than 90% of documents that any banks in the industry today receive documents are receiving in original copies, right? Original hard copies where all the signatures are read-in signatures, original copies, right? So this one is okay if, let's say, the exporter is located near to the bank's trade window, right? They can present the documents. But if, let's say, you're talking about an exporter who is geographically not too close with the trade window, he probably needs 50, 60 kilometers apart. So in order to present the documents over, right, now with this direct export presentation, the option is they can actually submit electronically, right, to the banks. So what happens is that the banks, once they receive this electronic image, they will then check the documents based on that. And if documents all okay, comply, the banks will then issue a covering schedule to the exporter, right? So the exporter, once they receive it on screen, they can print this covering schedule. They can attach it together with the originals because the originals they are still holding, right? And they can query it directly to the issuing bank. Okay, so this basically helps the time taken for physical documents to arrive at your own exporting bank counter, right, for checking. And sometimes checking, if it's discrepant, you have to replace with some other documents, and right, so there's actually back and forth. So a checking process typically takes half a day, may takes up to 1 day extra or 2 days. Okay, so this basically helps to shorten a lot of time. So this is what we call a direct export presentation. Another service that would help an exporter is called a discrepancy analysis. Now, quite often, if it's going to be a frequent export, right? I think especially for commodities exporter, you have quite frequent export to a certain place or certain countries. Right? The LC could be the same and just repetitive a lot, right? Sometimes you may hit the same discrepancies over and over again. And as you know, as you hit discrepancies, you need to correct them again and rework. So this discrepancy analysis allows the bank to do an analysis. A report will come out at the end of the month. They will be presented to the exporter and let them know from documents perspective, from category perspective, what are the common discrepancies, and that actually greatly reduced the amount of discrepancies. Now, the final one here is on e-banking. Now, e-banking is the buzzword, I think, 10 years ago, but I think lately, together with the pandemic, I think e-banking has been gaining more and more popularity. So what are the benefits of e-banking? Of course, there's no physical documents. That's number one, we have touched before. E-banking today is different from last time. Nowadays, it can actually capture large file attachments of up to 10 megabyte space, because a typical export submission may take up 1 or 2 megabyte, but this one can take up to 10 megabyte space. There are certain fields of parties within the documentation you can use over and over again, because this is actually soft copy template, right? Tracking, right? Because it's electronic, when this is actually presented, it's actually stored in the bank's memory. So this can actually be tracked, and you could also have historical files on how old transactions has been done, when the payment can actually come in, how long will the payment come in. All this is stored in the database, right? And of course, for companies looking for audit trail, this is where you can actually get your information. So in the past, sometimes companies may want to know a little bit more on these transactions. They may have to call up the call centers and get some extracts and documents, and this will actually take time. So this, with the system, web-based system, client can go in and immediately check from there. Now, lastly, this is just to explain that how the bank supported documentary trade during the pandemic. I think during the pandemic, we can see that actually there's a lot of issues. One of it being during the movement control order. Of course, the movement control order is typically to ensure that less movement is around, make sure the COVID doesn't spread, and people are, ensure they stay at one place. Now, because of that, some of the issues that we do face from the exporter is that they can't present their documents to the bank. Okay, it could be because of the 10-kilometer restrictions. It could be cross-district, cross-sub-district issues, or even cross-state issues. That they can't actually send their documents to the bank. Now, what the banks has been providing, right, to circumvent these issues is the e-banking, the digital channels, the one that I mentioned earlier, that a digital copy goes to the bank, and then the original copy goes directly from the exporter to the issuing bank. Okay. Now, the other issue that we see is also country lockdowns, right? I think sometime last year there was quite a long period of country lockdowns in certain countries, that the pandemic cases were quite high, right? So what happens there means apparently the documents, if you track it, it goes from here, shipped all the way. If it's via DHL, it will probably sit in somewhere in the DHL warehouse, right? The documents cannot dispatch to the issuing to the issuing banks. Okay. Now, what certain banks have actually done is actually they look at the LC, right, and then they actually revert the LC to allow for copy documents via email, right? Email is still a source where we know that we can, we still check, we can receive and we can send. So that will be the channel to use. But certain rewording needs to be done on the LC to allow for copy documents, so that as and when this is completed, right, then if need to, the BL can be telex released to obtain the goods. Okay. Now, the third thing we also encountered was extending payment maturity. Okay. This is because due to the working capital cycle gets stretched, right? The credit terms all get stretched because businesses get slowed down. payments received is also slow. So as a result, in certain cases, we also receive whereby a request to extend payment maturity in the LC terms. This is something not normal in normal times, right? So if the LC states this is 180 days, it's 180 days, right? But then if during the pandemic, we do see requests asking for a further 180 days extension. So under UCP, no, we can stretch until certain time, but beyond that, may not be advisable to stretch it because LC has an expiry period. Post the expiry date, is not feasible to extend credit tenors. So that has to be done something like an outside agreement, right? So we do encounter certain cases where agreement is signed, and the understanding is there that is a bilateral understanding between the exporting bank and the importing bank to pay at a certain extended future date. Now, finally, is the other issue is also on bank moratorium deferment. So this one is, I think, the banks in Malaysia, generally in the industry, they have already participated for more than at least 3 times already. So this is in supportive of deferring the what do you call that, the interest or the profit settlement, right, to a later date. So with that, I would actually conclude this session, and would like to look at the Q&A to see if there's any questions over there. So generally, we have now completed this session. Well, just to sum up, in the last 45 minutes, we have basically covered what revolves around international trade, the methods of payment, trade and working capital cycle, and lastly, understanding of documentary trade. So let's see if there's any questions for this session. Anyway, if you have no questions now, it's okay. You can actually have your questions sent later as well. I'll be more than happy to look into your questions and respond to you individually on this.